If you think the US economy is cruising along just fine, think again, because today's data tells us something very different about where things could be headed. In the last few days, one of the most important measures of American economic health, how much everyday people are spending, came in far weaker than expected, and that's shaken markets, changed expectations for interest rates, and raised real questions about how resilient the US economy really is going into 2026. Welcome to the US Report, where we break down exactly what today's numbers mean, not just in abstract terms, but in ways that matter for your money, your job, and the future of this economy. Before we get deeper into this, make sure to hit the like button, subscribe to the US Report, and tap the notification bell so that you're always the first to get updates on major economic news like this. Because what we're talking about today could shape the rest of this year as financial headlines. Let us start with the big headline that is on everyone's mind right now. The U.S. retail sales report for December 2025 came out this week, and the numbers are telling a very different story from what most economists had expected. Retail sales, which measure consumer purchases at stores, online, and across many categories, were essentially flat in December compared to November. That means U.S. consumers, who together make up roughly 2/3 of total economic activity, did not increase their spending at all during the critical holiday period when spending is usually strong. This flat reading, a 0.0% change month over month, was significantly below forecasts. And it shows that consumers may finally be feeling the strain of higher prices, slowing wage growth, and depleted savings. In November, retail sales had risen by 0.6%, and analysts were expecting a moderate increase in December, but that simply did not materialize. Now, why does that matter so much? Think of consumer spending as the engine that drives the U.S. economy. When Americans spend money, businesses sell more goods and services, companies hire more workers or pay higher wages, and overall growth accelerates. But when that engine begins to sputter, as we saw in this report, it can have ripple effects across the entire economy, slowing growth and affecting confidence in both Main Street and Wall Street. And that's exactly what we saw in the markets following the release of the consumer spending data. U.S. stock markets reacted with a mixed performance. The Dow Jones Industrial Average managed a slight gain, reaching new highs, but the broader S&P 500 and the Nasdaq Composite both ended lower. What was even more telling is that Treasury yields fell sharply as investors priced in the possibility that the Federal Reserve might now cut interest rates multiple times in 2026 to support the economy if growth continues to weaken, rather than keep them elevated to fight inflation. Bond markets, in particular, are signaling a shift. When yields drop, it often means investors are seeking the safety of bonds because they fear slower growth ahead. In this case, the weak retail sales report has propelled traders to adjust their expectations for future Federal Reserve action, moving away from a higher for longer stance, and instead betting on rate cuts later this year to prevent a deeper slowdown. Speaking of the Federal Reserve, let's break down how all of this plays into monetary policy. For much of the past 2 years, the Fed has been focused on curbing high inflation by keeping interest rates elevated. While inflation has come down from its peak levels, it has remained stubbornly above the Fed's long-term target in certain categories, like housing and services. But now, weak consumer spending and signs of a softening job market are making policymakers reassess their priorities. If consumer demand continues to fall, the Fed faces a tough choice: keep rates high to tame inflation or cut rates to support growth and avoid a deeper slowdown. Economists and markets are now closely watching upcoming jobs reports and inflation numbers for clues about how the Fed might act. A stronger jobs report could keep the pressure on rates, while weak employment data, coupled with slowing consumption, could make cuts more likely. In many ways, the U.S. economy is at a crossroads, and every piece of data coming out now is being scrutinized for signs of what comes next. Let's take a closer look inside the retail sales numbers themselves. While the headline number was flat, the breakdown shows that spending was weaker in several key categories, including furniture, electronics, and other durable goods, while only a handful of sectors like gasoline stations and some building materials saw modest gains. Overall, the lack of broad strength in consumer purchases tells us that Americans may be tightening their belts as they face higher living costs and uncertain economic prospects. Another piece of context that adds to the story is consumer confidence. In recent weeks, consumer confidence measures, which gauge how optimistic households feel about their financial future, fell to levels not seen since 2014. This aligns with the weaker spending data and suggests that people may be cutting back because they re-worried about jobs, wages, and prices. A drop in confidence often precedes lower spending, which can further slow economic growth. Now, let's talk about business behavior. Weak consumer demand doesn't just affect shoppers. It affects companies and how they make decisions. Retailers have responded to the slowdown by cutting back on inventories, closing underperforming stores, or slowing expansion plans. Some major retail chains have reported weaker holiday sales and are reevaluating their strategies for the year ahead. This kind of corporate caution can translate into slower hiring and reduced investment, which then feeds back into the broader economy. At the same time, certain sectors have held up better than others, showing that not all is bleak. Luxury goods and high-end categories continue to see some resilience from higher-income consumers, even as lower-income households cut back more aggressively. Analysts describe this as a kind of split recovery, where parts of the economy remain strong while others falter. But because overall consumer spending is what feeds into GDP, the broad measure of economic growth, weakness in the mass market has outsized importance. Looking at the bigger macro picture, the U.S. economy still showed strong growth in the second half of 2025, with GDP expanding at a healthy pace. But these recent consumer spending trends raise important questions about momentum going into 2026. Even if growth remains positive, a slowdown in the rate of expansion can have meaningful impacts on inflation, jobs, and financial markets. We should also mention the role of savings and credit. As of late 2025, household savings rates had fallen to multi-year lows, meaning that consumers have less financial buffer to maintain spending when times get tight. At the same time, more households are relying on credit cards or borrowing to cover expenses, which can increase financial stress if rates remain high or incomes don't grow fast enough. So what does all of this mean for you as a viewer of the U.S. report? First, these economic signals suggest that we're in a period of uncertainty where consumer behavior is shifting, markets are adjusting, and monetary policy may be entering a new phase. If spending continues to slow and confidence remains low, we could see slower job growth and more cautious business investment in the months ahead. That's not the same as a recession, but it does mean the pace of economic activity could cool from the robust readings we saw in 2025. Second, the data underscores why upcoming jobs and inflation reports are absolutely critical. These reports will help clarify whether the economy is weakening more broadly or just experiencing a temporary slowdown after strong growth. They will also shape expectations about interest rate decisions that affect borrowing costs for mortgages, car loans, business investment, and more. As we continue to monitor how all of this unfolds, it's important to remember that economic trends don't change overnight. Patterns emerge from a series of data points, and that's why economists, investors, policymakers, and regular Americans pay close attention to every retail sales release, every jobs report, and every consumer sentiment index. They are pieces of a larger puzzle that tell us where the U.S. economy might be headed next. Thanks for staying with us through this deep dive into the latest U.S. economic developments. And now I want to hear from you. What do you think is going to happen next with consumer spending and interest rates? Will Americans start spending more again, or are we entering a period of sustained caution? Drop your thoughts in the comments below because your perspective matters and we read every comment. If you found today's update helpful, please share this video with friends, family, and anyone who wants a clear, no-nonsense breakdown of what's happening with the economy. Sharing helps others stay informed and helps support the channel so we can bring you more content like this. Thank you for watching the U.S. Report. Stay tuned for continued coverage as new data comes out, and we'll break it down for you with clarity and insight right here.